Picture this. You've got $5,000 in Chase. Your neighbor has $10,000 in Bank of America. Your coworker has $20,000 in Wells Fargo. Everyone in America combined, about $18 trillion in bank accounts. Huge number. All that money sitting safe in banks, right? Wrong. Total cash actually sitting in all US bank vaults? Only about $2 trillion. Wait, 18 trillion in accounts, 2 trillion actual cash? Where's the other $16 trillion? Doesn't exist. Never did. Banks just typed numbers on screens, created money from nothing, perfectly legal. If everyone tried withdrawing same day, system would collapse instantly. Only works because people don't know. That's fractional reserve banking. Today, we're breaking down the biggest magic trick in modern economy. Now let's get into it. How banks create money from nothing? Quick note. This info comes from multiple sources. If something's wrong, drop a comment. We make economics so simple that anyone with zero knowledge can understand. Most people imagine banks like giant money warehouses. You deposit cash, they keep it safe, you earn interest. Simple, wrong. Banks don't just store money. They create new money simply by issuing loans. No printing machine, no physical cash, just numbers typed into someone's account. Sounds ridiculous, but this system is foundation of how modern economies work. When most people imagine how banks work, picture something simple. You deposit money. Bank stores it safely in big vault. When someone needs loan, bank takes part of your deposit, lends it to them. Feels logical. This old story often linked to fractional reserve banking, but not accurate description of how banks actually work. So what does fractional reserve banking mean? Word fractional means only part. Reserve means special money that banks use paying each other. When you transfer money from Bank of America to Chase using ATM, Bank of America must send reserve money to Chase. This reserve money, not cash, you can hold. Digital balance that only banks and central bank use. In some systems, physical cash in vault may count as reserves. To keep simple, we'll focus only on central bank reserves. Reserves cannot be used directly for loans. Never leave banking system. Job is settling payments between banks. Remember, reserves are money from central bank for commercial banks, not from your deposits. If banks need reserves, get them from central bank or from other banks, not from your deposits. Fractional reserve banking means system where banks don't need holding 100% reserves compared to total deposits. Example, bank named Weiwei Bank. 10 people each deposit $1,000 into Weiwei Bank. Now, Weiwei Bank has $10,000 in deposits. Then Weiwei Bank has $1,000 in reserves. Came from central bank lending or transactions with other banks. Person named Bob wants borrowing $1,000 from Weiwei Bank. If rule says bank must hold 10% reserves against total deposits, means Weiwei Bank with $10,000 in deposits must hold at least $1,000 in reserves. Since Weiwei Bank has $1,000 in reserves, meets requirement, can lend $1,000 to Bob. When Weiwei Bank lends $1,000 to Bob, simply types number into Bob's account. Bob gets $1,000 loan. Weiwei Bank now has $11,000 in total deposits. Original $10,000 plus Bob's $1,000 loan, which counts as new deposit. Meanwhile, bank's reserves still $1,000. Another borrower named Lisa wants borrowing money, but this time bank cannot lend because still only has $1,000 in reserves. Less than 10% requirement for $11,000 in deposits. Would need $1,100. In past, banks required holding certain percentage of reserves, such as 10%. But today, modern banks no longer required keeping fixed percentage of deposits before they lend. In many countries, including United States, reserve requirement now 0%. That's why people say banks can create money from thin air. Can banks create unlimited money? Not that easy. When someone gets loan, they eventually spend that money. Maybe withdraw cash, maybe transfer to someone in another bank. Continuing story. Weiwei Bank has $11,000 total deposits and $1,000 in reserves. Bob still has his $1,000 loan. If Bob withdraws $300 cash, Wee Bank must use vault cash, giving him $300. If Bob transfers $700 to landlord and Bank ABC, Wee Bank must send $700 of its reserves to Bank ABC. Even though banks can create new deposits when they lend, cannot lend unlimited money, still need enough cash and reserves handling what customers do with money. How do banks make money? First, from interest. When Bob repays his $1,000 loan with $200 in interest, bank earns $200 as profit. Wait, didn't bank create loan money from thin air? Should bank get full $1,200 as profit? Remember, Bob already withdrew $300, transferred $700, bank already lost that $1,000 earlier. Now gets it back, plus interest, only keeps interest as profit. Apart from loan interest, banks also buy safe assets like government bonds, earning extra profit. Not all their cash just sitting doing nothing. What if Bob can't repay loan? Bank loses amount. Bob already spent? Must be covered using its capital cash or reserves. Even though sounds like unlimited money, banks still need real cash reserves and capital to operate. Why use system where banks create money? Might feel strange. Actually exists for reason. Modern economies need credit growing faster. Businesses take loans expanding faster. People need mortgages buying homes. Governments borrow money. With this system, banks lend money faster in larger amounts, without waiting for savings growing first. Could we do this without borrowing? Of course, but much slower. Everyone would need saving money first. This system comes with real risks. If banks lend too much money, floods economy, can push prices up. Especially housing or financial markets. That's how bubbles form. If lending gets excessive, bank itself becomes weaker even though deposits grow. Most borrowers withdraw cash or transfer money to other banks. Reduces banks' vault cash, drains reserves. When reserves and cash get too low, bank cannot move money around freely settling payments. When many customers try withdrawing simultaneously and bank cannot meet demand, this becomes bank run. Bank can collapse. When one bank goes bankrupt, people panic. Think their money in other banks might get frozen too. Rush withdrawing savings simultaneously. Governments or central banks may limit how much people can withdraw per day or declare bank holiday. Banks temporarily closed, preventing panic withdrawals. If this happens, makes people panic even more. Creates chain reaction of bank runs, crashing entire economy, similar to what happened in US during Great Depression. Traditional percentage-based reserve rules no longer main limit on lending. In United States, reserve requirement now 0%. Banks not required keeping fixed amount deposits before lending, but doesn't mean banks can lend without limit. Real limit today is capital and liquidity. Capital is banks' own money. Money from banks' owners and shareholders. If bank has many unpaid loans, starts losing cash because borrowers already spent money, bank must use own capital covering losses. Banks need enough capital absorbing losses, avoiding failing. Won't banks take pledged assets covering losses? Yes. However, those assets can be illiquid, hard to sell, like houses. Capital acts as quick way covering losses temporarily. Then there's liquidity. Liquidity means how easily bank can move money in and out, like how water flows smoothly. Even though loans create deposits, banks still needs enough cash or reserves paying when customers withdraw money or send to other banks. If liquidity becomes too low, bank must slow down lending or can end up facing bank run. That's why, even though banks can technically create loan money, still very strict about who gets approved. Their cash reserves and capital limited. Difficult replacing quickly? Bottom line, banks don't simply lend out your savings. They create new money when they issue loan. Use reserves for transfers to other banks or cash meeting withdrawals. This cycle of money growing and shrinking influences how modern economy works today. That's why when banks start collapsing, entire economy can collapse along with them. 18 trillion in accounts, 2 trillion actual cash, 16 trillion created from nothing. System only works on trust, on people not asking for their money all at once. Here's question. What happens when that trust breaks? when everyone realizes simultaneously their money doesn't actually exist? Northern Rock learned in 2007. Lehman Brothers learned in 2008. Who learns next? Don't forget to subscribe so you don't miss any videos.